members in Stock Trading Made Easy on Facebook. I am your host and facilitator, Marlon Aldridge. Let's go ahead and get started. All right. Well, I can see I made a mistake already. I didn't quite fill out the total agenda, but these are some of the things that we're going to cover. What are options? Call versus put options, key terms in options trading, buying versus selling options. We're going to focus more on buying options since this is a basic course. You're going to need a whole lot more privileges and experience if you want to sell options. They're a lot riskier. We'll talk about what selling options entails. Okay, let's get into the terminology because that is very important. Options are financial contracts, let that word sink in, that give you the right, but not the obligation to buy or sell an underlying asset like a stock at a specific price. We'll specify what that specific price is later, by a certain date called an expiration date. In other words, an option lets you lock in a future buy-sell price today for a limited time, okay? You purchase an option by paying a premium. It's a fee. The option seller, also called the writer, receives this premium and in return must fulfill the contract if you choose to exercise your option rights. The buyer can decide to use the option or let it expire. The seller has an obligation if the contract is exercised. Just remember this, where there is a buyer, there is always a seller, okay? If there is a buyer, there is always, well, I'm going to take that back. That is not true. You want to make sure that there's enough liquidity there. So in other words, before you enter into an option contract, you want to make sure that there is significant interest. They call it open interest. So before you actually choose an option, you want to make sure that you are also, there is a pretty substantial size of open interest. In other words, contracts are already open, okay? Options allow you to profit from price changes without owning the stock outright. They are a form of leverage. You can control a lot of stock with a smaller investment. However, if the expected price move doesn't happen, an option can expire worthless and you lose the premium you paid, okay? Again, in this last definition right here, we are assuming that we are buyers and not sellers, okay? If you put up, say, $500, then the most that you can lose is $500, okay? If you're a seller and you get and the buyer decides that they want to exercise that option because the price moved in their direction, then you could potentially have some downside more than what you would have if you were simply a buyer, okay? Okay, a call option. There are basically two types of options. There's a call option, there is a put option. Okay, a call option gives the holder the right to buy an asset at the strike price. Call buyers are bullish, okay? So if you purchase a call, you are expecting the price to go up. That is very important. If you are buying a call, you expect the price to go up. So let that sink in. Call buyers are bullish. They hope that the asset's price will rise. If you buy a call and the stock's price and the stock's market price goes above the strike price, the call increases in value. You could buy at the lower strike and sell at the higher market price, okay? A put option gives the holder the right to sell an asset at the strike price. Put buyers are bearish. They hope the asset's price will fall. If you buy a put and the stock's market price goes below the strike price, the put increases in value. You have the right to sell at a higher strike price while the market is lower. Okay, let me take the time to explain that. If you buy a call option, or if you buy a put option, what you will normally do next is to sell it. Okay, and regardless of which one you buy, we need to think like business people that if you buy something, you want to sell it at a higher price. That is the only way you're going to make money. So if you buy a call option, for example, you want to buy it, and you know how we are, we want to buy it normally at a discount. Okay, at least I attempt to buy it at a discount. Okay, and if the price moves upward, then I could possibly make a profit if I get out in time. In other words, I want to close the position. So when I purchase, I'm going to buy to open a position. All I have left then, if I don't buy any more of that call option, is to close the position. And to close it, I must sell, okay? And I expect to sell at a higher price. The same thing is true with a put option. Now, here's what you need to know. If with a put option, you're bearish, you expect the price to go down below the strike price that you have chosen, and you are the one that chooses the strike price. You expect the price of the stock, of the underlying stock, you expect it to go down. So as the price of the underlying stock goes down, the value of the put that you purchase goes up. So the value of the put itself, the put price, is inverse to the value of the stock. With the call option, they move in the same direction. That's really all you have to remember. In every option trade, there's a buyer or holder and a seller or writers, okay? Sometimes you'll hear that term right. That's a person who sells, okay? The buyer has a choice to exercise the option, use the right to buy or sell, while the seller has an obligation to fulfill the contract if the option is exercised. Call sellers must sell the stock at the price if assigned, and put sellers must buy the stock at the strike if assigned. Okay, that's if it gets exercised. Somebody decides, somebody on the other end, if you're a buyer, there's a seller, right? Now, say, for example, if you have a call, let's say if you have a call option at a strike price, I'm just going to make up something, of $100. Let's keep it simple. You set a strike price of $100, and that stock goes above $100. Okay, if somebody sold it to you, then you can go ahead and buy it at the cheaper price. Now, you can buy the underlying stock. You can do two things. You can go ahead and exercise your option. Ooh, the stock went from 100 to 115. I want to buy it at 100. In other words, you bought it at a discount. Okay, you can buy it and hold it and anticipate that the stock will continue to rise, or you can take profit right away. You can say, well, hey, I have $5 worth of profit. I'm going to go ahead and sell it. Okay, I bought it. Now I'm going to sell it, and I get 500. Well, actually, if it goes up $5, and I bought each contract, by the way, in options, one contract entitles you to 100 shares. Okay, that's where the leverage comes in. Instead of buying one share at $100, okay, let's say if the option price for that $100 share is, say, $10, okay, then you can purchase, what is that? For $10, you purchase 100 shares, that's for $1,000 then. You can control 100 shares of a stock that has a value of $100. That's where the leverage comes in, okay? So was 100 times 100, that's what, $10,000. You control $10,000 worth of shares, okay, for $1,000. That's where the leverage comes in. Okay. I see you, Brian. You have any questions so far? All right, here's some other terms. The strike price, I've already mentioned that. The set price at which the option can be exercised. You're the one who chooses this as the option purchaser or seller. It's the price per share at which you can buy or call or sell or put the underlying asset if you exercise the option. For example, a call with a $50 strike lets you buy the stock at $50 no matter what the market price is, okay? Now, of course, you would only buy it or exercise your option to own that stock, those 100 shares, right? For $50, you'd only do that if the price moves above $50. It makes no sense to buy a stock or exercise your right to buy a stock at $50 when its price is below $50. That would make no sense whatsoever. Okay. So exercise an option. I want you to think, ooh, I want, and you're a call purchaser or buyer, then you want to own the stock. Okay. Now, people like me, I don't want to own the stock. I just want to benefit off the price increase. So I can sell it without exercising it, right? And make $5 per share, depending on how many contracts I purchased. The expiration date, the deadline for using the option. After the expiration date, the option expires. It's void. For American style options common in US stocks, you can exercise anytime up to that date. For European style, only on the expiration date. If you don't exercise by expiration, the option simply expires worthless. Okay? Now, typical for me, and I'll get into this a little bit more, I don't want to go anywhere near close to the expiration date because of something called time decay. We'll talk about that a little bit more. Premium, the price of the option, what the buyer pays and the seller receives. The premium is typically quoted per share. Most contracts represent 100 shares. Very important to understand that one contract entitles you to control 100 shares. It's not one share. The minimum is 100 shares. The price depends on several factors: the current stock price, the strike price, time remaining until expiration, and the stock's volatility. For instance, options on volatile stocks with lots of time remaining cost higher premiums. I'll give you an example would be Tesla, very high premiums on those, okay? Contract size, standard stock option contracts cover 100 shares of the underlying stock. So if an options premium is quoted at $2, buying one contract costs $200. Keep this lot size in mind. A seemingly small premium actually multiplies by 100 for each contract. Okay. I normally just move my decimal place to the right 2 times and or just multiply by 100. Exercise. To exercise an option means to use your right to buy or sell at the strike price. Call holders exercise to buy the stock at the strike price. Put holders exercise to sell the stock at the strike price. In practice, many options are not exercised by the holder. That would be me. Instead, holders often sell the option itself before expiration if it has value. If an option is out of the money, not profitable to exercise, it will simply expire without being exercised. Okay. All right, buying versus selling option. Buying an option is a long position. So when you hear that word long, just think buy, replace it with buy. If you buy a call or put, you have a long option position. You pay the premium for the right to exercise in the future, right? Remember, to exercise, you can say, hey, I want to take ownership of that stock. If I am a buyer, if I'm a seller, of course, you're going to be obligated. If the buyer exercises on you, then you're going to have to sell it. And if that happens, 9 times out of 10, or probably 10 times out of 10, you're going to lose money in that particular scenario. Your risk is limited to the premium paid. Remember, this is for the buyers. If the option expires worthless, that premium is your total loss. You're not obligated to do anything. You'll exercise only if it is profitable, or you can just sell it. You don't have to exercise it. Remember, you can just sell it and take the money that you have gained. Buyers typically hope for a big move in the stock price, up for calls, down for puts, okay? You buy a put, remember you expect the price to go down. I'm going to keep repeating myself because I need you guys to understand that these things they have to be committed to memory so that you don't end up getting yourself in an option that you didn't intend to get into, okay? You don't expect the price of the underlying stock to go down, then it makes no sense to buy a put option, okay? Now, I'm going to tell you this just to help you out, just from my experience, and then I can only tell you this from my experience of trading options, is that I am going to buy calls more than I am going to buy puts. I will normally buy a put to force the hand of these of the institutional holders, and I'll talk about that a little bit later. They are going, as soon as you get into a trade, it is 9 times out of 10 going to move against you, okay? So I like the term options because you have options it's like chess, like playing chess, that will allow you to benefit should the price go up or down, okay? Then, of course, there's some risk mitigation factors that you can take, like setting stop losses and then taking any profits that you have once you see profits. You can take that. You can go ahead and sell. Okay, especially if it meets the mark that you've set for yourself. And we'll talk about planning a little bit later. Selling an option, short position. Also called writing. Whenever you hear that word write, remember you are a seller. Or short, you are a seller. You're expecting the price to go down if it's a put. No, I said that wrong. That's for buyers. Let me tell you about shorting position. You can short a position on a call. You can short a position on a put as well. Now, it's normally going to do that to receive income, okay? And it'll normally be people that own the underlying stock. It doesn't have to be for people that are new to trading. Typically, if you are an owner of shares, at least 100, right? At least 100 shares of some stock that has an option chain, you can elect to receive income by, say, example, selling a put at a strike price below which you do not believe the underlying asset will fall, okay? So if you sell a put at a strike price of $90, you expect that strike price to stay, or the price of the underlying stock, you expect it to stay above, and I just forgot what I just said. Let's say if it's $100, the strike price is $100, you expect it to stay above $100. Okay, as a matter of fact, you want it to move up, or you want it to stay up in value. That way, you'll make money on the underlying stock, and you'll get to keep the premium that you will now receive, okay? Remember, the buyer pays the premium, the seller receives the premium. So whatever premium you received, as long as the strike price is below the underlying price of the stock, then you get to keep the premium that you receive. Okay. Okay, so if you sell or write a call or put, you receive the premium up front, but you take on the obligation. Remember, if the seller, not the seller, but the buyer on the other end exercise that option, and they would only do that if they're in a favorable position, then you're out of luck, okay? And you can potentially lose more than the premium that you have received, okay? Because you're going to have to either buy, you're either going to have to buy those 100 shares. You're going to have to buy those 100 shares in order to cover that position which has been exercised on you, okay? This means that the buyer exercises, you must fulfill the contract, sell shares at the strike price if you wrote a call, or buy shares at the strike if you wrote a put. Okay, option sellers have higher risk. They can face large or even unlimited losses if the trade goes against them. For example, an uncovered call writer loses more as the stock goes higher with no cap on the loss. Okay, by uncovered, that means that you do not own the 100 shares. Let's say if you had one contract and you don't own the 100 shares, then your loss is going to go up significantly, because you'll have to, if you're uncovered call writer, then that means that you're going to have to buy 100 shares at whatever strike price that you participated in, okay? Now, if you own those shares, it's no problem. Well, you're going to lose money, but at least you may have bought those shares that you own, those 100 shares. You may have bought them at a lower price and still may benefit if they've risen in price since you've owned them. In summary, buying options offered limited risk. You can only lose the premium and potentially high reward, whereas selling options provide unlimited reward, limited reward, the premium, but potentially large risk, okay? Beginners are generally advised to start buying options or using coverage strategies rather than selling options naked due to their risk involved. This is what I do now. I only purchase. I don't sell options. Okay, the basic strategy, a long call. Remember, long, that means that you're going to buy a call option. And you would only do this if you expect the price to go up. It's one of the simplest option strategies. By paying a premium, you gain the right to buy the stock at the strike price in the future, okay? If the stock's market price goes well above the strike before or at expiration, your call becomes very valuable. You could exercise it to buy the stock at a cheaper price and then sell at the market price, or just sell the call for a profit. Okay, that second part, or just sell the call for a profit, that's what I do. I don't want to own the stock. I only want to participate in the profit. Okay. The upside for a long call is theoretically unlimited because the stock's price can keep rising with no fixed cap. The higher the stock goes above the strike, the more profit for the call holder. You essentially have leverage exposure to the stock's rise. For a relatively small premium, you control 100 shares via the option. If the stock skyrockets, the percentage gains on the option can be huge. Let me stop here for a second to tell you this. You're going to get burned if you expect to make a lot of gains, 100% gains, 200% gains. You're going to get burned. If that happens, it's pure luck. Okay. I'm happy to get 25%, or really if I can get anything. But I set a strategy for 40%. If it doesn't look like it's going to make it to that level, I will accept 25%. Okay. I want to say that again. If you're greedy with options, you're going to lose all of your premium. Risk versus cost. The maximum loss on a long call is the premium you paid. Remember, if you're a buyer, whatever the premium you paid, that's the most that you can lose. If the stock fails to rise above the strike price by the expiration, the call will expire worthless. You lose 100% of the premium in that case. For example, if you bought a call for $200 for one contract, and the stock's price stays at or below the strike at expiration, you lose $200. Okay, now it's one thing they're not adding here. Actually, if you buy one contract at a premium of $200, what they didn't tell you here is what the strike price was. Okay, if you buy a call, what you're going to do is you're going to add $2 to the strike price, and as long as the stock stays above that value, then you don't lose your premium. Okay, whatever the stock market price above, let's say this, I'm just going to make up something. I'll use 100 as my example. Let's say if you the strike price was $100 for this theoretical stock, and it was $2 for one contract, then you'd add $2 to $100. So that's $102. As long as the value of the underlying stock stays above $102, then you're going to have some profit. Okay. If you buy a put, you're going to subtract that. Let's say if you buy a put with a strike price of $100, then you just take the $2 off. That'd be $98. So as long as the underlying market price of the stock stays above $98, then you're going to have some profit. We're not going to specify what that profit is. You'll have some profit. So if you're buying a call, add the premium to the strike price. If you're buying a put, subtract the premium from the strike price, and that is the value where you break even. That's called the break-even point. Okay. In the first example, $102 would be break even at expiration. In the second example with the put, $98 would be your break even at expiration. When to use. A long call is suitable when you are bullish on a stock. We've said this a number of times, and we'll give you some examples. So I'm not going to keep, well, I guess I probably should to let it sink in here. A long call is suitable when you are bullish on a stock and expect a significant increase before the option expires. It can also be used to leverage a bullish view. You gain upside exposure with much less capital than buying shares. Now, this is really why people get into options, because it lets them share in the profit, if there is one, without having to put up as much money. I want you to imagine trying to buy 100 shares of Tesla, for example, which is over $300. You're going to spend over what is that? I can't do the numbers in my head anymore. Was that 30 something or 300,000? Let's see, 300 times 100. Yeah, that's over 30,000. You're going to spend over 30,000. Whereas here, typically, and I'll show you some examples. I'm going to open up my trading platform and show you some things inside of there. But you need to strike. However, you need the stock to move above the strike price. That should say strike price plus the premium to profit. This is your break-even point. Long calls are popular for short-term trades around events or when you want to risk limited capital for a potentially large gain. Okay, now here's what they mean around events. You're looking for some good news. You're looking for some good news, which is most likely but not all the time going to move the stock in a particular direction. For a call, you want that news to be good news, so you expect the price to go up. Basic strategy for a long put. Remember, you're buying put, you expect the price to go down. It means buying a put option because you expect the price to fall. It's essentially a bearish strategy or a way to ensure against declines. By paying the premium, you have the right to sell the stock at the strike price, regardless of how far it drops in market price. Okay? If the stock's price plunges below the strike, your put becomes very valuable because you can buy the stock at the low market price and immediately sell at the higher strike price using the put. Okay, profit potential. The upside for a long put increases as the stock price falls. The lower the stock's market price goes below the strike, the more profit for the put holder. In the best case scenario, the stock could theoretically fall to zero, and you'd profit roughly strike price minus zero minus the premium. Remember, if you buy a put, you're going to subtract the premium. The example I gave previously was that the strike price was $100. You subtract the $2 premium, the break even would be $98. Okay. In reality, a drop in zero is rare. Don't expect that to happen. Okay. But this illustrates the maximum gain on a long put is substantial, stock price approaching zero. Risk versus cost, the maximum loss on a long put, like any option you buy, is the premium paid. If the stock price doesn't fall below the strike by expiration, for instance, if it stays flat or rises instead, the put will expire worthless and you lose the entire premium. We've already spoken about break even. For a put, you're going to subtract the premium that you paid from the strike price. When to use a long put is useful when you are bearish on a stock, expecting it to decline, or when you want to protect value in a stock you own. We call it hedging, right? Let's say if you own 100 shares of Tesla and you don't want to, and you want to minimize your loss on the shares that you own, you could buy a put to help limit the loss that you would have on the underlying stock that you own. Okay, so if there is some loss, you're going to minimize it because of your purchase of the put. Of course, you'd want to own as many options contracts as you have shares of Tesla. Okay. When to use a long put is when you are bearish on a stock, expecting it to decline, and when you want to protect. I've already said that. Some investors buy puts as insurance on stocks in their portfolio. This is essentially the protective put strategy, owning the stock and buying a put to guard against losses. We call that a protective put when you own the underlying shares and you want to hedge against potential losses. As a speculative play, long puts can yield significant gains if a stock drops sharply while limiting your risk to the premium paid. Okay, others strategies here, basic ones. This is a covered call. When you hear that word covered, that simply means that you own the stock already, okay? A covered call is a conservative strategy where you sell a call option on a stock you already own. Cover means you have the shares on hand to cover the obligation if the call is exercised, okay? Remember here, we're going to sell. Normally for income, we want to generate income. If we sell, that means that we're going to be the one that receives the premium, okay? And that's the most that we can ever get. That's going to be our maximum gain, is going to be whatever that premium is. The goal is to earn extra income, i.e. the premium from the stock position. It's like collecting rent on your shares. And I think that's a great example. How it works, that you hold, say, 100 shares of a stock and you sell one call contract against those shares with the strike price above the current market price. You immediately receive the premium. Okay, if the stock falls below the strike until expiration, nothing happens. The option expires and you keep your stock and the premium. If the stock rises above the strike, the buyer will likely exercise the call and you will have to sell your shares at the strike price. You still keep the premium, but you cap your upside. You don't get any gains beyond the strike price. Okay, you're going to have to sell some of those shares that you own. Now, of course, if you've already made a significant profit on those shares, they've risen in value. By the time you actually sell a call, then you're still going to have some profit, but you're not going to be able to participate in the stock's rise, any further rise in the stock. What is the purpose? Investors use covered calls to generate income from stocks that they plan to hold. It's most effective when you have a neutral to moderately bullish outlook and you think the stock will maybe go up a little or stay flat, but not soar dramatically in the short term. In that scenario, the call's premium adds to your returns without likely losing your shares, okay? Many people systematically sell covered calls on stocks to earn regular premiums. I mean, it's risky now, but you have to be pretty sure about the shares that you have, or you could simply buy before expiration, okay? Now, of course, in that case, you're not going to get the full premium that you receive. You'll get some portion of it. And in those cases, too, you don't want to be unrealistic. Say if you get a premium of $1,000, I'm just going to make something up. They're going to put that into your account immediately. As soon as that sale that you've written a call and it's executed, you're going to receive that $1,000 immediately into your account. Okay. Now I'm going to tell you from experience, these, and I do believe there is some manipulation in our industries, in our markets. Both the NASDAQ and the New York Stock Exchange. Okay, they're going to probably move against you. Okay, so you have to have an effective plan of action. And for me, I want to make sure that I'm able to watch my positions. As soon as I get a profit, and that's say if it's at 25%, I'm most likely going to close out that position to keep that profit. Okay. So when you sell a call or if you sell a call, you don't want the price to go up. You want it to stay where it's at when you exercise it, okay? Or you want the price to go down. You do not want the price to go up if you are selling a call, okay? Because you become obligated. You're obligated if it's exercised by a buyer, okay? And they would only do that if it's in their advantage. And if it's in their advantage, that means it's to your disadvantage, okay? Trade-offs. A covered call provides a small downside buffer. The premium can offset minor stock drops, but does not protect well against big declines, okay? So in these cases right here, you don't expect big moves. you typically want to do this with stocks that don't move that much, okay? There are analysts or the markets are bullish on these stocks that you own, or maybe just you're bullish, but they don't move that much. So this is an opportunity to earn additional income on stocks that you already own and that you anticipate will go up in value, but they don't have a lot of range. In other words, they're not very volatile stocks. Price doesn't move that much. And so that's a potential strategy that you could use to earn additional income on stocks that you already own. All right, protected put. Again, it means that you already own the shares. This strategy involves buying a put option for a stock you own. It's insurance policy against the stock dropping in price. You pay a premium for the put, but if the stock plunges, the put gives you the right to sell your stock at the strike price, thus protecting you from further losses below that level. If the stock rises or stays stable, you don't need the insurance. The put may expire worthless, and the cost was the premium paid. Okay. Again, here we are buyers of a stock that you own, and you anticipate that the price will go down. Okay. Remember, for put, you expect the price to go down, and this is a form of insurance for the stocks that you own. And this is an example. Suppose you own 100 shares of XYZ at $50 each and want to guard against a big dip over the next few months. You buy a put with the strike of, say, $48. Okay. If XYZ falls below $48, your put rises in value or can be exercised to sell your shares at $48, limiting your downside. Okay. If XYZ instead goes up to $60, the put will expire worthless. But you still keep the stock gains minus the small premium you spent for the put. In essence, a protected put establishes a floor price for your stock, the stock price minus the premium cost. No matter how far the stock might crash, you can exit around that level. Okay, so you're going to have some loss if it goes below the strike minus the premium, but it's only going to be that what you paid in terms of your premium. Why to use it? It's a hedging strategy, and investors use protected puts when they are bullish on a stock long term. They don't actually want to sell it, but worry about short-term downside or uncertain events. By buying the premium, they obtain peace of mind that a worst case is hedged. It's comparable to buying insurance. You pay a premium for protection and hope you will never have to use it. If the insurance or put expires unused, that means that things went well, the stock stayed up. The cost is just a premium akin to insurance premium. Okay. Key point, protected puts limit losses without capping upside. Now, this is real. Now, keep in mind, this is for shares that you own. Okay. You continue to participate in any stock gains. The trade-off is the cost of the put option, which eats into your overall return. Okay, protected puts can be used occasionally around earnings or events or as a rolling strategy, but continually buying puts can become expensive over time. Okay, investors must weigh the protection benefit against the cost of repeatedly purchasing put options. Okay. They use that term rolling over. So before expiration, you can decide, hey, I'm going to put more money into this and roll it over into the next expiration date. But again, that can get pretty expensive, like they said. Here's what a profit loss diagram looks like for a call option or long call. Vertical axis here is the profit or loss. Of course, right here, the line in the middle, that's at $0, right? And remember what I said earlier. I said if you buy a call for some premium, you're going to add that to the strike price. Here's the strike price here in the middle. Here's the additional price that you added for the premium. This line right here represents the expiration date. This is also your break even, okay? So if at the expiration date, you are at break even, let's use our example again. Let's say this is a $100 strike price. We paid a $2 premium. Then this becomes $102. So if at expiration, the price is at least $102, you don't lose anything. Okay? You don't lose anything. If it's above $102, you're going to have some profit. Okay? Your profit in this potential example is unlimited. You're going to gain dollar for value. If it's above the stock price, the strike price, or let's say break even, let's just call it break even, then dollar for dollar, you're going to gain dollar for dollar on 100 shares. Underlying goes up every dollar, you're going to get $100 if you own one contract. I hope that makes sense. If it goes up $2, you just made $200. Goes up $3, $300, et cetera, et cetera. The only thing that you can lose is the premium that you paid for, in this example, would have been $200. Let me let that sink in now. You bought one contract, the premium was $2, so you spent $200 to control 100 shares of a stock that's valued at $100. Now that's leverage. You can't really beat that. Hey, but here's that was just an example. I doubt that you're going to be able to purchase options at well, there's a way to do it, but $200 for a strike price of $100. Long put option. Notice that it is in reverse. In the last example, let's go back. I want you to look at the lines. This one slanted to the right for a call option, a long call. This one is slanted to the left. Okay, here's your strike price. Let's use the same example. Theoretical strike price of $100. And you're going to pay a premium. In this case, your break even is going to be the strike price minus the premium that you paid. So if at expiration, as long as the stock's price is above $98, you're going to make a profit. Make sense? Falls below that, you're going to lose money up to the amount of the premium that you paid. Okay? Long call payoff. The long call payoff diagram above is the classic hockey stick shape. If the stock's price at expiration is below the strike, the $100 strike, the call finishes out of the money and you lose 100% of the premium, a flat loss of $10 per share in this example. You can see the blue line. Well, actually that wasn't the example that I used, wasn't $10, it was actually $2, but it's still the same, still the same thing. Once the stock price exceeds the strike, the call options value increases dollar for dollar with the stock. Above $100, the blue line rises. For each dollar, the stock goes up $100. The options payoff increases by $1. break even occurs at 110. Our example, it would have been 102. Okay, if that stock price, the call holder's profit is zero. They gain $10 intrinsic value, but pay $10. We'll talk about intrinsic value as well if we have some time here. For stock prices above 110, the call is profitable. There is no upper limit, and as the stock keeps rising, the profit grows indefinitely. The line continues upward. This illustrates the appeal of long calls, unlimited upside potential. For example, if the stock went to $130 by expiration, the call payoff would be $20 per share. How did they get that? $130, which is the underlying price of the stock, minus the $100 strike price, minus the $10 premium. Okay, so that would give us $2,000 profit per that contract. Hope that makes sense. Summary: a long call has limited downside, lose premium if wrong, and large upside if the stock moves up. But remember, if the stock doesn't move above the strike in time, the option expires worthless. Timing and choosing an appropriate strike are crucial for success in long calls. Let me slow down. Brian, talk to me, man. You have any questions on anything? Unmute yourself if you're on your Okay, now the long put payoff. Long put payoff is essentially the mirror image of the call. If the strike price at expiration is above the $100 strike, the put finishes out of the money, since you wouldn't sell the stock at $100 if the market price is higher. Okay. In that case, you lose the premium. A flat loss of $10 per share in this example. Again, ours was $2, but still the same applies there. The blue line is flat at $10 on the right side, the price for 100 shares and above. Once the stock price falls below the strike, the put option's value increases dollar for dollar. As the stock drops further below $100, the blue line slopes upward. With each dollar, the stock falls below $100. The puts payoff grows by $1. Okay, the break even is $90. Again, ours would have been $98 at that stock price. Your $10 intrinsic gain equals the premium, $10 premium paid, netting zero profit. Brian, you got any questions?
I'm just trying to check out all the terminology right now. I'm sitting here with my wife. So we're putting money to the side to start trying to get into this. So this is very it's a lot, but I'm learning a lot too. But we both learn better with examples. You know what I mean? But just trying to get the terminology.
Just be patient. We're getting to that. I'm going to open up. Well, actually, I already have my trading platform up.
Okay.
And you hit it on the nose. Terminology is key. You got to understand the terminology. More than this right here, once you see the platform, you're going to see how it works.
Okay.
I just need you guys to understand that you can be a buyer or a seller. For now, I would it is less risky to be a buyer than a seller.
Okay.
Okay.
Yeah.
Unless you want, let's say, unless you own shares, at least 100 shares or whatever, right? Then you can buy insurance.
Okay.
By being a seller or a writer. Okay. But for people that are just getting into it, I would be nothing but a buyer.
How long have you been doing this?
Well, the options, I started options when COVID back in 2000. Well, wait a minute. When was COVID?
2019. My dad passed of COVID, so around 2019.
Yeah, that's when I started trading.
Okay.
I was doing it part-time. Now I'm doing it every day.
So this is your full-time gig?
Huh?
This is what you do full-time now?
This is what I do. This is what I do every day.
Okay, cool. Like I said, we're trying to learn the terminology. So what we're doing is taking screenshots of all the language that's on the.
Oh, I
that
can
you sent
send you
out.
this. Don't worry about
Oh,
that. I can send you this document.
okay, fantastic. Appreciate you.
Yeah, I want you guys to, more than anything, I want you to ask questions if you have questions, okay?
Okay, thank you.
All right.
All right.
All right, risk involved. Now, again, I'm talking about buyers. All you can lose is your total premium, okay? Now, here's what I'm going to say about that. Don't put up more than you're willing to lose. And I definitely don't want, and I'm going to say this. I day trade options. I do not want to hold them past 2 days. If I hold them past 2 days, I'm getting nervous. And I would only hold them past 2 days is that only if I either expect something to happen on that next day, okay? Or I hope it moves in a direction that will allow me to get out at an amount at a loss that I'm comfortable with, okay? And I'll show you an example of that in a trade I'm in right now. And I'm going to tell you some of the mistakes that I made so that you don't make some of the same mistakes. And now here's why you don't want to hold options. This line right here, time decay. Okay? I trade weeklies. They expire on Fridays, right? So I normally want to get in. I can do 2 days. I'll do. Sometimes I may even get in on the last day, but that's, man, it's gone. Hey, I'm expecting something to happen, okay? And I really just my knowledge of that underlying stock. I'm only going to deal with so many stocks. I'm not going to trade any old option. I want to trade only stocks, options on underlying companies that I'm comfortable with, and I pretty much know how they move, okay? Well, this thing called time decay, all I need you to know is that part of the price of an option involves time. So you're paying for time. The more time, the higher the option. Okay? That's why I trade weeklies, because they're going to be cheaper. You can go out 2 weeks, 3 weeks, a month. You can go out 2 or 3 months, but you're going to pay for that time, okay? In addition to the intrinsic value. Now, here's you saw that term earlier. You heard that word, intrinsic value. Let's explain that. Let's say if a stock is $100, right? And let's say you get in at for example, let's say you go below that, you want to be in the money. Let's say a strike price of what did I just say, 100? Let's say if you go in at a strike price of $90. What you're going to do is you're going to take the market value, which was 100, minus the strike price, and you're going to get $10 of intrinsic value. Okay? So in terms of the option price, you're going to pay $10, plus you're going to pay for some time. There's a time, you call it time value. So your option price is going to be more than $10. This option price is going to be the intrinsic value plus the time value. Okay? Now, let's say if the strike for a call, now this is only for a call. Let's say if the market price is $100 and you're looking at a strike price of $110. Okay? You're going to do the same thing. You're going to take the strike price. In other words, in this case, there is no intrinsic value. All you're going to have is time value. Okay? I'll show you that once I open up my platform. They'll let you know what being at the money, in the money, and out of the money. For calls, you want to be in the money. In other words, you want there to be some intrinsic value. And that's going to be, again, the value of the market price minus the strike price. Okay, for a put, it's the opposite. You take you want to be in the money for a put option, you're going to take the strike price minus the market price, and that'll be the intrinsic value. Complexity and understanding, risk, all this. I'm going to come back to that later. I need to see what time we're at here. I don't want to. There's a lot to cover, but I think what I'm going to do. Let's see where we're at. Let's go into. I'm gonna pause this, and I'm going to go into my trading platform so that you guys can see with your eyes what's actually happening here. Let's see if I can go straight to that. Shit! Oh my God, I didn't close that out, did I? I don't remember closing it out. Let's see. Oh, there it is. Okay, this platform right here is called Thinkorswim. It's just a trading platform. The company is Charles Schwab. Okay, here you can see I have my trade tab. I've already entered. This is Tesla. T has a ticker of TSLA. And here are the expiration dates. You're going to look for something called option chain. Let me close it up. Open up option chain. Here you can see you have an expiration date of August 1st. Here you can see I already hold positions that are going to expire Friday, August 1st. I can go to August 8th, which would be the Friday after. I could go to August 15th. See, these have weeklies. Look, and I can go all the way out to December of 2027. Okay, let's go look. On the left side, I have my calls. On the right side, I have my puts. Now, here's where you're going to hear terms like in the money, out of the money. On the call side, look at the color purple. Those are all in the money. Okay? Here's what I mean by in the money. That means that they must have intrinsic value. The current price for current bid or ask price for Tesla, the current ask, that's how much sellers are holders of the stock. They want to sell it. They're willing to sell it for $317.72. Okay? So in the middle are the strike prices. So here is a strike price of $317.50, which you can see is below $317.68. So $317.50 is what we would be considered in the money. That's where the purple color comes in at. Now, as you move further away, look at the premium. If I wanted to buy Tesla at a strike price of $287.50, I could do so for $28.85. I'm going to click on it just to show you if you want to execute this trade. I don't want to be a seller, by the way, so you got to be, I don't know if you guys can see that little bubble down there, the dialog box. I want to be a buyer. So I'll go over here. You can see it changes to buy. I click on it. And sure enough, I want you to associate the color green with buying. Over here, we can see we're on the buy side. It automatically sets up for 10 contracts. I don't want 10. I would normally put 1 or 2 or something, or however many, how much I'm willing to spend, okay? Over here, it would be the midpoint. I could actually buy this if I wanted at a midpoint of $29.55. Okay. Here's what the ask is. They're going to populate it with the ask, but I normally going to do the middle between the bid and the ask. Watch this. If I take $28.85 and I add it, I'm going to do it with my calculator. I'm going to take $28.85, 28.85 plus 30.25. I'll add those together and divide by 2. and I should get that 29.55. And sure enough, that's what I get. Okay. The difference between the bid price, which is what you, Brian, and your wife are willing to, that's the maximum amount you're willing to pay for this option. And this 30.25 is the least amount that the seller is willing to purchase it for. Normally, you'll get it for the mid price, which is going to be the $29.55. So let's do this. Now I'm going to show you what the intrinsic value is, and what's left is going to be the time value. Okay? This is for an expiration date, as you can see, of August the 1st. Contract expiration. You saw that term used in the definitions. So what I'm going to do, I'm going to take the current ask price, $317.72. I'm going to subtract $287.50, and I get $30.22 is the intrinsic value. I want you to notice that if you're in the money for calls, there is no time value. Okay, all you're gonna, or should you say that very little time value, if any. Okay, you're only gonna get time value when you are out of the money for a call. This is the black space down here. Okay, so you can see for $320, a strike price of $320, this $6.20, that's no intrinsic value. That's all time value. Okay? As you go further out, but this is near the money. You're going to hear three terms: out of the money, near the money, or at the money, which are basically about the same thing, and then in the money. Okay? Generally, if you want to purchase a put or a call, you want to purchase it near or at the money. So a strike price of $317.50 is very close to where the bid and ask price are now. You can see that the premium is cheap there. Okay? Now, of course, you don't, unless you're very bullish, you don't want to go with the strike far above that, because it may move in the opposite direction. But look, the premium gets cheaper as you move further out. But here's another thing that you have to consider. Over here is a term called delta. Okay? That also is the probability of you making a profit before expiration. So I want you to see that the probability, you can change these 2%, 46%, 52%. Okay? Normally, when you purchase an option, whether it's a call or a put, you want to purchase it near the money where delta is close to 50. That means you have at least a 50% chance of the stock moving in a positive direction. And then, of course, it could also move in the opposite direction. Okay? So you can go down here, get a higher probability, but man, you're going to pay a whole lot of money for it. Okay? And it could still potentially move against you. And you lose that very high premium that you paid. Okay? So again, normally we want to purchase at or near the money. Okay? Any questions on that? Of course, over here for put, we don't want to be a seller. So make sure you don't make that mistake. A lot of people make mistakes by executing the wrong trades because they weren't paying attention. But let me show you what a sale looks like, and then it'll make sense why the colors are going to help you out. Now here we just let's do a sell. Notice that the color changes to red. Okay. So when you see red, things aren't going your way. When you see green, things are going your way. Just look at it like that. Red are sellers, green are buyers. Let me say that again. Red are sellers, green are buyers in this platform. And that's how I set my colors up anyway. All right, what else do I want to say about this? So look, you determine whether you're going to be a buyer or a seller. For us, for beginners, you normally want to be buyers until you close the position out. Then it will change to red. You're going to set your number of contracts. Just remember, let's go ahead and execute this. I mean, it's not going to, options, they don't trade on the weekends, but we can still see how much we're going to pay for this. Watch this. So I got 10. And let's say if I want to purchase at 720, here's what I'm going to do. I'm going to multiply by 100. So that goes to 720 times 10. So I should expect this to be somewhere around $7,200. And sure enough, there's the cost, $7,200 minus the cost of each contract. I'm going to pay 65 cents per contract. Actually, I'm going to get a better platform because I hear there's a place that has a there's a platform that has a faster execution and cheaper option contracts, $20 per contract as opposed to 65 cents per contract. Excuse me, 20 cents per contract as opposed to 65 cents per contract. Okay, so that's, of course, I'm not going to execute it, so we'll close out of that. All right, now let's go to my charts. Now, I'm going to say this. I don't trade without charts. I do not trade. Here are some contracts I'm already in with Tesla. Here I can see I have 2 contracts. I paid $6.35 per contract. So if you multiply that by 100, that's 635 times 2. That's about $1,270, right? $1,270 is how much I paid. As you can see, I'm at a loss. Okay. As you can see, I'm losing. I paid what? $635 right now. This is the close as of Friday, 4 p.m. I'm down $300. Okay. I have another contract over here with a strike. Well, let me do this. Let me go up here and show you this. Here's the contract. There's Tesla. Here's the expiration date, 2025, August 1st. This was a put with a strike price of $310. Okay. Now, I'm still learning. Let me tell you why I chose that. Tesla had an earnings report. Here's the chart on Tesla. Tesla had let's go up here and look at the full. Let me maximize this and I'll let you. I'm going to go to the daily. Here this is an interval of 1 day, and each candle, these are candlestick charts. Each candlestick is 1 minute. That's normally what I'm going to use when I'm day trading. But let's take this out to 1 day, and I'll show you why actually. Let me expand this a little bit. This was on Thursday. This was Wednesday. Tesla was trading at over $330. Then they came out with an earnings report. Here you click on this, we can see what. Let's get out of that. Let's go up here and change the tools here. So we click on that. It should open up, and it's not. I didn't want it to do that. That's some hanky-panky going on there. Okay, now it doesn't want to. Let's do this. Okay. Okay, that's what I wanted right there. The analysts were forecasting that, let's go back to it. The analysts were, well, wait a minute. This one's, we need to look at the, this isn't, the analysts were predicting that they would make about 29 cents per share. They actually made more. Their further guidance, though, but look what happens. You can see that the stock dropped. It was trading in the $330 range. On this day, it went as low as $300. So it dropped over $30. I thought it was going to keep dropping. Okay. It had a high for that day of $310. Now you understand why I put in a put for $310. But look what happened on Friday. Instead of the stock continuing to drop, it went up. Okay? That's why I'm in a losing position on that put. You guys see how I did that? A strike price of $310, which was the high for that Thursday. I expected the price to continue to drop. It did not. I will not bet against Tesla again. That's the lesson. That's the lesson that I learned. People love that company for some reason. They got a lot going on. But I had one that I was able to purchase. I took a positive position because that sucker skyrocketed up. I said, man, I need to get in on this. And so I purchased a call, which means I was bullish at $317.50. How much did I pay for it? I paid $7.15. Okay. As you can see, I'm making a little bit of money, but I'm not making a lot. Now, typically what I'll do, this doesn't come set up like this. When this is my active trader window. What I'll do is I'll add in this profit loss. You can come here, you can actually customize these. And as you can see, I've taken this profit loss and added it to my current set. So that helps me out when I'm trading. I can actually see when I'm making money or losing it, and I can sell if I want to. So very quickly, I can hit one of these sell buttons to get out of these contracts. I could sell it at wherever, right? But here's a gamble. You gotta, and like I said, you got to, I'm going to attempt to get out of this one tomorrow because I'm not, as far as I know, Tesla could keep going up. It could go back into the $330-something range, okay? Now, the most I can lose is at $1,270, okay? So let me show you some of the strategies. Here's a chart. Let me show you how I get that chart. I'm going to go back to my trade tab. Now, I'll hover over some strike price. This is just going to be an example. I'll use the one that I've already had, the 317 call. I'll hover over it. I'll right click and see where it says copy. That's the option contract. I can copy that. Then I'm always going to use a chart. If you guys aren't using charts, you don't know what you're doing. You shouldn't be trading options. And I'll come here and I'll paste it. So I'll paste it. I'll see that come up. Now, here's what you want to do, because I'm going to tell you what I did Friday. I had all my option change picked out. And I went up here and copied and pasted, and it kept the last contract in there. I wasn't paying attention, and it kept a contract in there that I didn't want, and I executed it and got into a bad trade. I had to get out of it. I took a little loss, but it put me in a bad position because if I had stayed with the trade or the option that I wanted, I would have made some money on it because it was actually a good contract. I entered into the wrong contract and ended up losing a little bit of money. Okay. You want to be able to execute very fast. You do not need a platform where you have to go through a lot of dialog boxes to get in and out of trades. You need to be able to hit one button. I'll normally use these buttons up here to get out of a trade or into a trade very quickly. If I want to get in very quickly, boom, I'll hit buy market. If I want to get out quickly, I'll hit sell market. If it's not moving, I'll only do that if it's moving real fast. The market's moving real fast. I'll normally use these two. If it's not, I'll either buy at the ask price. That's what the seller is trying to sell that. They're very quick. Or if I say I don't want to pay that much, I may buy at the bid price. That is what, now when I say bid, I'm talking about this little panel right here. The B is bid, the A is ask. The spread is 5 cents. Okay, normally if I hit market, it'll give me what's in the middle, $22 or $7 and 22. Might as well, you can round that, but you can get it to this price right here. It'll take it out 3 decimal places. You take those two numbers, add them together, divide it by 2, that's what you're going to get. So I could buy. Remember, green is buy, red is sell. Just remember that. This is Thinkorswim platform. I have it on auto send, so whatever I hit, it's gone. Okay. Average transaction response time for this, the execution time from Thinkorswim is about 0.4 seconds, I think, or 0.04. I'm going to get another trading form, which I call Lightspeed, which is going to execute far faster than that, 4 times faster than that. Okay, I'll do that next week. Let me slow down because I know I'm talking fast. Now I got this here. I have it set on 1 minute. I know it looks like garble, but what I can do is now you see the candlesticks. Green is good. That means the price went from here, opened up here at the beginning of that minute. It closed here at the beginning of that minute. Here it's the opposite. It opened up the beginning of that minute here. It closed 1 minute later at that. It went as low as $7. Now these are option prices. That's why I put it there. I'm responding to option prices. Okay. Now my strategy for a call is to look at, I will always have the stock chart for the underlying option. I don't use these. I want to look at the 1 minute candles. Of course, I'll make it large enough where I can see it. And I'm going to have this white line is my 10 period, 10 candles, right? Moving average. It's an average. Just think average. It's an exponential moving average, but it's the 10 period average. This is the 20 period average. I always want my white line to be above my green line, and I always want the lines to be upslope. I want to be walking uphill. Okay, I'm also going to use my MACD. The same thing. I want my blue line to be over my yellow line, and I always want to be walking uphill. I want to see green. I do not want to see red. Whenever I anticipate that this blue line is going to turn down, I'm going to check. I'm going to give preference, more weight to what I see here. If the white line is always moving up, and the steeper it is, the better. The green line is always up, steeper it is, the better. I'm going to stay in that trade. As soon as I see these lines beginning to turn down, I'm gone. Okay? Even if they get horizontal or top out, I'm gone. I'm not going to stay in that trade. Okay? This is why you want to watch these options, because I'm going to tell you from experience, as soon as you take a position, you execute a trade, it is most likely going to go against you. And I believe that the markets are being manipulated. Okay? Doesn't mean you can't make any money. You just need to know what you're doing. Do not go into an option unless you own some underlying stock and you're trying to do some insurance, what they were talking about in terms of insurance with the protected puts and the covered calls and all of that. Do not buy a put or a call without owning the underlying stock. Okay. Unless you can watch that stock price move up or down, according to some strategy that you have set up. Okay. Now, I'm not going to talk much about the strategies. You're going to have to watch some of the other videos to see how you can use charts to know when to get into a trade and when to get out. Okay. All right, let me say some other things about here. Let me check the time right quick. It's 3:27. We got about another 30 minutes. Let me slow down because I know you guys probably have questions. What questions do you guys have? All right, let's keep going then.
You have a question?
No, I don't. I mean, it's a lot, so I'm lost totally. But so I don't. Yeah, so I don't even know what to ask at this point. It's just, I mean, this is my first time seeing everything. So
Let me ask you this. Now, have you ever traded stocks before?
no.
Okay, that's why you're having issues. Now, let me tell you this. It seems like some people were more interested in options than they were in stocks. Okay. I would never trade options until I have first traded stocks. So, because this is highly speculative in terms of your risk tolerance. You need to maybe go back and look at the first video we did back in February, because options may not be for you. Okay, some people are very conservative and they don't like to take on a lot of risk. These options, I'm going to tell you, they're as soon as you take a position, you may have you could probably go, I'd say 5 minutes, and then if you can get that, and then that trade is going to go against you. Okay.
Wow.
I personally believe that these markets are being manipulated by institutional buyers, because what they have done, let me tell you how sneaky these folks are. They went to the brokers and remember how they automated trading? You can now, all trading is automated now. Okay. You don't have to call the broker on the phone anymore, who would normally have somebody on the floor of one of the major exchanges making these trades for you. What happened is that the majority of trades are no longer done on the floors of the New York Stock Exchange or through NASDAQ. The institutional buyers, the big money managers, what they call the smart money, went to the brokers and said, hey, we'll buy the shares from you and we can sell them to the public. Now, who in the hell came up with that? That's where I'm telling you with 100% confidence, and this is from experience, you go into one of these trades, and if you can't watch it, it's going to go against you, and you're going to lose your money. Okay? This is why I sit here I'm in front of this computer all day, and I'm watching, and I got to be there between 9:30. I must be prepared. Okay? I have a notebook that I keep. I'll keep all of my trades in there. I have reflections. I gotta know what I'm going to do the day before. I have to know. Let me show you some of the things that I do to prepare for a trade. I'm going to show you some other documents here. And even with that, I'm determined to get better at it so that I can make an income where I don't have to go back to work. I'm retired now, so what am I trying to do here? Let's see. I'm going to show you some of the things, and this just comes through experience, man. The more you do this, the better you're going to get at it, but you got to study. So you guys are doing the right thing just by becoming knowledgeable about it. But if you're never traded before, of course, it's going to be difficult for you to understand some of the things that are being discussed. But let me show you some of the things that I'll do. What did I call it? Where am I at? Wrong. Go back to That's there. I think, where did I put that? I got something that I have a document where I keep all of my no, that's not it. That's not it. I generate all kinds of stuff, man. And I will tell you this, knowing if you're good at math, that's going to help you too.
Yeah, she got a math degree.
Oh, she'd be excellent at this then. If she once you get the knowledge, and you can trade, by the way, you guys know you don't have to trade real money, right? You can trade the paper account.
Yes,
Yeah.
yes. Uh-huh.
Yeah, so that's what you guys want to do. Now, if I were you guys, if you really want to do this, go back and look at all those other videos.
Oh, we are. This came up on my Facebook. I said, let me look at this while
Okay.
we're here.
Yeah, do not get into trading options until you are first comfortable with how to read charts, knowing all the terminology, risk reward management, there's all kinds of things you can do, man, to be good at this, but it's going to take some time because I'm still learning. I'm no expert guru in it that's making a whole lot of money, but I'm going to get there. I can tell you that.
So how long did you trade stocks before you got into options?
Now the stocks, I've been trading those for years, man. Hey Brian, you know me for working down there at St. Clair. I started there in '98.
Yeah.
Man, I was the worst professor there. You know why?
Trading stocks.
I was in my office trading stocks, man. When the dot-com boom came out, oh my God, man, I could be in the classroom and I get them something to do and I go in my office to look on my trades and everything, man. Wasn't preparing for class. I mean, I was terrible, man. But bruh,
weren't you a professor of physics?
Yeah. I can make, hey, one time I made $30,000, man, and
oh shoot,
in a couple of minutes, and then turned around and lost it. Oh, here. But I would one year, like I just started doing this.
Okay.
And I'm gonna show you why. Like I'm only gonna trade Tesla, and I'm only gonna trade one at a time. I made a mistake of you guys can't see this, but I have 3 computers here, all very fast computers, and I had charts and options on each one of those computers. It was overwhelming. I said, man,
that's tough.
Well, I don't do that anymore. I'm only going to trade one at a time now. But here's what I do is that I'll copy where I think the stock's going to go. Okay, this was the day that I traded Tesla, the ones that you see, and I went the wrong direction.
I see.
I went the wrong direction. That sucker went back. I was thinking it was going to go down. I was like, man, I'm gonna make a killing, and that sucker went the wrong direction. So what I'm gonna do now, I'm gonna put more option chains in there, calls and puts, these ideal premiums. Now I came up with this because I noticed that sometimes I was paying too high a cost in the premium, and I settled on this number of 2.2%. So of the strike price. So these numbers here are 2.2% of these strike prices right here on each side. Okay. Now it's very hard to get them unless the stock, let's say, for example, this strike price of $297.50. Okay. The only way I'm going to get this 655 is that if the underlying price is below $297.50. The further it goes below 297, the lower the cost of the premium is going to be.
Okay.
But listen to what I said. I said that means the price is falling. I don't buy calls for that. I want the price to go up. So what I'll do is I'll wait for it. And I don't do this all the time. This is ideally what I'm attempting to do, is that I'm going to wait until the price falls below 297, gets to this level, and then turns back up. That's what I'm going to buy.
Okay.
That's where the chart comes in. Okay. Same thing for mine. Now look at this. Look at this, man. You see any mistakes here? Look at this. On this side, this is my puts. Look what I did.
That's kind of crazy.
I got a call right there. It should be on the other side.
Oh, I see.
You can make mistakes. Hey, bro, on Friday, I made 2 mistakes. I put a wrong contract in there, right? I put the wrong contract in there, and then I tried to cancel it. And I thought I had canceled it, and I didn't cancel it. And when it got to the price that I wanted it at, I bought again, and now I had 2 contracts that were in a bad that were in an option chain that I didn't want. So you gotta. So this is gonna be my way where it's gonna allow me to move faster, because you gotta be fast when you're doing this, right?
Okay.
And I haven't done it for tomorrow. I gotta fill these out. I'm only gonna do Tesla since that's the one I'm in. I gotta fill these out with where I think it's gonna go. I'm gonna load them into my computers. I'm still gonna use 3 computers now, because I want to be able to move. I have to act very quickly. So here's one strategy I'll use. I'll go study my charts. Like personally, I'm going to go back to my platform. I'm going to go here to my chart. I'm going to go to the daily. I always want the larger contacts. I don't go straight to my 1-minute candles. I want to go to my dailies. Let me expand this again. And this is where your wife's math is going to come in. I'm going to show you guys, even though you're novices, I'm going to show you some things. This is a Fibonacci right here. I took it from the high to the low, and these are like what you call the golden ratios. And this is where you can see that Tesla was trending around the 50% level. You look at a lot of the candles, that's where it's been, at that 50% level, right?
Okay. Yeah.
And so potentially that's where it's trying to go back to. Let me make this a little larger so you guys can see this. And I have what's called some daily studies. I'll go up here in my studies, and this isn't going to make sense to you until you guys look at some of those other videos. I got a lot of stuff here, but they have something. Let me show you what the studies are. I can go to edit. I have my moving averages. You got to have these.
Okay.
You guys are in school. You're college educated. You know that you had a GPA. Some of your grades were above your average, your GPA. Some of your grades were below. We want our stocks or our candles to be above average. We do not want to be in positions where we are below the averages, okay? And we always want our averages to be sloped upward. So what I'll start with is what's called this Bollinger Band. It has to do with statistics. So I don't like, these are here for various reasons, but I can turn them off. And I just want to show these 2 at the bottom. This is where your math is going to come in. In the middle is the average. It's the 20-period average. Okay? This line down here is 2 standard deviations away. This line here is 2 standard deviations above this average in the middle. Okay? So as you can see, that price normally stays within those bands. So this gives me an indication as to where the price can go. The number at the top you can see is $341.59. That's 2 standard deviations away. Or it can go as low as $296. Okay? So what I could potentially do is go into the option chain and copy and paste all of the strike prices. Okay, I just forgot what did I say that bottom was? 296. I won't generally go that low. I could, if I wanted to be OCD, I could say, man, I'm gonna go the whole full range. Normally what I'll do is I'll go 1 standard deviation away. In other words, I'll take the average which is, and you guys can see that up here, but I got to move my cursor all the way over here. I'm going to pull the numbers from right here, but I got to move my cursor over so it'll give me that. So the number in the first number is the average. But I'm going to take the highest number, which is 341.59 minus 318.80. I'll get $22.79. That's 2 standard deviations away. I only want to go 1 standard deviation, so I'll divide by 2. I'm going to get $11.39. I'm just going to round it to $11.40. So what I will do is I will take the current price, on which of the close of Friday was $316.60, and I'm going to add that to $11.40. So I'll go plus 316. This is just one strategy. This is my strategy. It's $327.45. Okay, I'll do the same thing on the bottom. I'll take 316.06. Really what I'm going to do is take one of these prices, whatever the price is. I'd probably use this 317, but just for example, let's stay with 316, which was the close. And then I'll subtract 1140 from it. So I get 304.66. So I can round that to whatever that low number is. And so let's say 304 to 327. So I'll go back to my option chain and I'll go to 304. As you can see, I can get 300. So I'll copy 300. I'm going to copy them all the way up to that top. And I'll probably go above that. I'll go to 330. I'm going to copy all those, put them in a Word document, right? I can do the same thing for the puts. I'll put them in that Word document, and then I'm going to make a guess where I think it's going to go, where it's going to start, and all of that. And those are the ones that I'm going to put in my on my charts. Like say, for example, with this computer, I can normally get 2 on this. I'll have my chart for the underlying Tesla right here. Here you can see I have 1 put. I have another here. So there's 2. And then I have 2 other computers. I can put 3 on those because I don't need to see the chart because I already have it here. So I can put as many as, 2 here. And then I can put as many as 8 up, right? And then I'm just going to watch this to see where it's going to go. Ideally, and this is something I'm still experimenting with, I will try wherever it starts at. I'm right there at 9:30. 9:30, you're going to hear a bell. It's going to go off. The market's open. They're going to start trading. I want to get into a position wherever it opens at. I want to do a call, right? The other ones I'm going to do based on what my charts are doing and whether I can get in at the price that I want to get in. I know that's a lot, but that's just the way that it works, man. You gotta have some kind of game plan, and then what you got to do is don't put up a lot of money. Don't see what I put up. This is I'm not going to do that anymore.
Okay.
And the reason being, I was being too greedy. Okay, and I was losing money. So I got another strategy here where I'm not going to put up a lot of money. I was trying to make, just to show you how greedy I was trying to make $2,000 a day.
Okay.
Now, stocks, you can do that, but you got to put up a whole lot more money because you don't have the leverage, right?
Okay.
With options, you don't have to put up a lot of money to make decent money. $400 a day will, I can make as much as I was making in Sinclair. If I can make $400 a day, that'll be about as much as I made at Sinclair when I'm, right when I'm retired. So I want to replace that income. So here's what my strategy is, and it's still in the works. I figure I'll put up 4,000 a day. Each trade, I don't want to put up, in other words, I'm in a cash account. You can only make so many trades because you don't have your funds. When you buy, it's like cashing a check. You're going to have to wait for your funds to settle, right? But as long as I have enough money, I can put, if I trade 4,000 for the day, and let's say I'm going to risk $500 each time.
Okay.
That means I can trade 8 times that day. 4,000 divided by 500, that's 8 trades. And I won't be able to make any more trades after that because I'll have to wait for the next day until all of my funds are settled. Now hopefully I've made some money. I got more than the 4,000 that I started with. Does that make sense?
Yeah, it does. Yeah.
All right. So I figured I did a little math. This is where your wife gonna come in. I figured I'm gonna try to make 40%, right?
Okay.
But if I get 25, I'm cool. Or if I get anything, I'm gonna try to get out getting something. But at least if I can get 25%, that'll give me what I need to get to my 400.
Yeah.
And you got to write that down so you can see how all those numbers work out. You're not going to win every trade.
Okay.
Don't expect to win every trade, but if you win 60% of the time, then you're still going to make profit, right?
So let me ask you a question. What do you use to prognosticate the market? Like you brought up Tesla, and you I guess got some information that it may be going down and they're going back up. So what information do you use to Wall Street Journal or Financial Times or something like that?
Okay, let me tell you what I do. I'm gonna tell you what my routine is. Okay, I wake up in the morning, get my coffee, and then break it. I'm up at around 7 or so.
Okay.
Okay. I'll turn on Bloomberg TV.
Okay.
That's the best financial news that you can get. So I'm in my office. I got Bloomberg TV on. And also I have on each one of these down here, it has live news. So I can hit live news. It'll tell me what's going on with Tesla. I have my level 2. But there's all my news down there.
That's it. Okay.
On each one of these stocks, I can't do it on the options, but I can do it on the underlying. Show me all my news. Man, I was so confident that Tesla was going to continue to drop, and I guess wrong on that one.
Okay.
Okay. I thought I was going to make a killing, man. And that sucker changed direction and went right back up. So I'm not betting against Tesla anymore. That's one of my tips. I'm going to go to my tips because I know we're getting at the end here. Let me but that's my strategy. I got to have that TV on. I want to look to see what the markets are doing. I'm looking at NASDAQ. I want to see if the futures are positive or negative.
Okay.
Okay, because that seems to have an effect on what the tech stocks, and NASDAQ seems to have an effect on what's going to happen with the tech stocks. I'll tell you one that's got a killing going on, and after I get out of Tesla, because remember I said I'm only going to trade one option at a time. So I got to get out of Tesla, but here's the one that I really want to focus on, Advanced Micro. Let me show you what their chart looks like, their daily. Let me maximize it, but you can see that steep uphill, right?
Yeah.
Man, look at that hill.
I see.
That sucker's always been above that average for the most part. Here's below average. Look where those candles are.
Yeah.
Since May 16th. Really, if we want to go back since April the 24th. You're getting good grades, right? Look at those grades.
They've been killing it.
And since your wife is in math, she knows about, here's one term that you got to put in your memory. Here's where the math comes in. There's a term called reversion to the mean. Here's the mean, the blue line. That's the mean is just another word for average. And look what those candles do. They always come back where?
To the mean.
To the mean. That's what we call reversion to the mean. So don't expect whatever goes up, oh, it's coming down. Okay. But right now, AMD's on a good run. It may seem be 2 standard deviations. The candles may be above 2 standard deviations. We call that, when that happens, we say that the stock is now overbought. Expect reversion to the mean. It's going to start selling off. Green candles mean the buyers had more conviction. Red candles, let me take this weighted volume weighted average price. That gives you the word value. That lets you know if the price is overvalued or undervalued. Here I can clearly see that the value is $165.67. So right now, Advanced Micro is overvalued. In other words, you're probably paying too much for it. Okay? So I got all kinds of tools that I can use, and the math background helps me understand these tools, okay? But
so if you were to get involved with Advanced Micro, you're going to get involved with expecting it to go down.
Oh, hell no. I'm not betting against them.
Okay, you think it's going to continue to accelerate?
Ooh, I'm not betting against. Hey, Dow theories, these stocks generally go up. The stock market generally goes up. Right? Here's one thing I learned. To use more calls or be bullish more than you are bearish.
So do you do stocks?
Let me qualify that. Let me say this first. Let me qualify that. On tech stocks, be more bullish than you are bearish. That's all I trade. I don't trade. If it's not a tech stock, I don't trade it on option.
So are you still involved in the market too? Do you still do stocks too?
Yeah, I let Fisher manage my bigger account, but I do trade. I'm going to get back in doing some day trading too, but you got to become proficient. You just got to do this stuff, man. You can't listen to people like me talk and expect to become proficient in it. But I'd say you can do it with paper money, but you have to do it when the market's open.
Okay.
You can't trade paper money unless the market's open. Okay.
I got you.
So do
We're
that.
gonna go back to your February video. Is that on YouTube?
If you are you a member of the group we started, Stock Trading Made Easy?
I believe so. I'm gonna go back to my Facebook and see.
Yeah, see what groups you're in, and then you should be able to find the link, or I can just I'll text. What I'll do is I'll send you something in Messenger, and you can get it that way.
Sounds good.
Okay. Let me I need to get to some points. I want to give you guys some of the stuff I had to learn the hard way, so that where am I? Let me see here. I want to get back to my PowerPoint here. Let me go down. Well, this strategy stuff, you can learn that on your own. I want to make sure that I had, and this is the stuff I just learned from experience. Again, I keep a manual. I have all my trades in it, whether I made money, lost money. And then I put reflections at the end. All right, man, this is where I screwed up. This is what I did well. This is what I didn't do well. This is what I want. So here's what I want to tell you. This is what I learned. And this is for uncovered buying. Okay, so we're buyers only because we can minimize our risk by how much money we put up, and we don't want to own any stocks, okay? Only trade stocks with very high liquidity and range, such as Tesla, NVIDIA, Microsoft, AMD. Notice that they're all tech stocks. Okay, there's one part I did forget to show you, but let me get through this, and then I'm going to go back and show you what I mean by liquidity. It just means, liquidity simply means that there's a lot of open interest. It's just so many people, so many buyers and sellers that when you want to get rid of it, you're not going to have any problem with getting rid of it. Let me tell you what I did. Oh, I wanted to cry, man. It was this one company that is called, it's a biotech company. I mean, they're gangbusters making money. So, and I loved it because I owned it. I said, man, I'm gonna trade options on this. And I got into a option contract with that company, and I did not check the open interest. So I bought and I wanted to sell it. There were no people, there were no buyers. There were none. I wanted to cry, man. I wanted to get out and I couldn't get out because there was nobody buying it. That was a lesson learned because I lost a lot of money on that one.
So why wasn't anyone buying it since it was doing so well?
Just because it's a company that's not a well-known company.
Okay.
It doesn't have a large market cap, right? And their earnings are not all of that strong. Or they're good, but it's a relatively new company.
Okay.
They deal in plasma.
Okay.
Right? So there's not a lot of people trading it. And it doesn't have range. What I mean by range, that's the difference, but how much the price moves in a day from high to low.
Okay.
I only want to trade stocks that, like Tesla, like, man, you'll see a $30-something price change on Tesla. Right? Yeah. I only trade weekly options because they have the lowest cost. And I try to get them at a discount. The way and I'm giving you an example. If it's a call, I'll let the price go below the intended strike price that I have on my Word doc. And then as it turns up, hopefully I can get it at 2.2% of the strike price. Use long call strategies more than put strategies. I learned that the hard way too. When you're doing put, you're betting against. And I'll tell you this, put should normally have strike prices above your long call strike price. I made a mistake doing that. I traded on one, and I did it because it was cheap. Because when the market price for a put is below the strike price, you're out of the money. And the more you're out of the money, the cheaper a put option is. So I was being cheap. I said, okay, I'm gonna get this little cheap one. And it moved in the opposite direction. And I'm like, man, here I am with this option, and it's way far away from the underlying stock price, and I ended up taking a loss on it. Only use options on one underlying stock at a time, or you're going to get confused. You're going to be looking at running from computer to computer, and it's going to frustrate you. Here's the important: if you can't watch the stock price movement, don't trade options. You're going to lose your money. Time decay is going to work against you, and these people are manipulating the market. Okay. Stocks too now. I don't think it just happens for options. Don't seek unrealistic gains. I seek 40%, but we'll accept 25%. I'll accept less than that, but that's when I'm starting out. That's what my thinking is starting out. Don't put up a lot of money. I'll put up 500 or so. Only use platforms for very fast execution. I use Thinkorswim. It's pretty fast as far as I'm concerned. I'm gonna get an account with this company called Lightspeed. They're 4 times faster and much cheaper. I told you they're only charging 20 cents per option contract, whereas Schwab is charging 65 cents per option contract. Okay. Copy your option chain. I've already showed you that. And the reason being, I can sort of stop on that part with this one. Let me and I'm going to show you why, even how you guys are able to get around on your computer is very important too. I want you to think that, let's say stock price moving in some direction and it didn't move where I wanted it to move, then I got to go find an option, right? So what I got to do, the stock's moving, I got to run over here, right? I got to find the one I'm looking for, making sure I got the right expiration. Then I got to right click, I got to copy it, go back to my chart and paste it in there. And by the time I've done that, what do you think has happened?
Another movement.
Yeah, the stock is no longer where it was.
Yeah.
And now I got to go find another one. So yeah. I'll have those already copied and pasted. I mean, I'll have them already copied out. and it's going to shorten the time that it's going to take for me to come up here, copy it and paste it here. This will already be open. It'll populate, and then boom, I can buy where I want to buy at. Okay. There's a lot of management. I got to make sure that this number here always matches this number here. Because if I don't, I'm going to get into a short position when I try to sell, and it's not going to execute. It's going to screw me up. When I hit one of these buttons, I wanted to execute. I don't want to wait.
Okay.
Okay. So you have to have a platform that allows you to act very quickly. That's why I use this tab. Otherwise, I'm going to have to do all this. Watch this. Look at all these dialog boxes. Then I got to go to another one. Well, wait a minute. This is, and the reason it did that, because I got this on auto send. See how you can make mistakes? Watch this.
Man.
I'm going to turn that off. I'm going to go back. There's a number of ways I can do it. Now watch this. Then all that's going to open up. Then I got to check all this. Then I got to go here and do that. See all those boxes? By the time I've done that, stocks have moved in a direction where I'm not going to have an advantage at.
Yeah.
So speed, but you can see how you can click something and make a mistake.
So doing this is basically a full-time job for you.
Yes.
Right?
Yes.
Okay.
Yes.
As you go from 9:30, you're getting up at 7, getting caught up in the market, watching Bloomberg, Financial Times, whatever. And then you're going from when the market opens at 9:30, it's over at what, 4:30?
It's over at 4 p.m. And then
Okay.
once that's done, I got my reflections and I got to get ready for the next day.
For the next day.
Yes.
Man.
Yeah. So if you, this may not be for you guys if you don't.
Not yet. Not yet. Because we're still working. So.
But if you can, I'm convinced you can make money doing it. If, but you got to put in the work. You got to keep studying. But more than anything else, let me tell you, I guarantee you can make money.
Mm-hmm.
What's going to mess you up, which has messed me up, is being too greedy.
But my wife is very patient. Not me. She's very patient. More patient than I am.
You got to be, and it's going to teach you. One of the things I love about this, I've always considered myself a disciplined person, but this stock trading makes me more disciplined, not just in trading, but in every aspect of my life. It sort of, I have that built into me now where if I get off track, I'm gonna immediately get back on track because this stock trading has, and options trading has ingrained that in me.
I got you. I appreciate you, man. We're starting to get, I'm gonna go back to make sure I'm in that group and go back to February. You said February, right?
Yeah, I'll get, as soon as I'm done here, I'll get on and I'll tag you in some stuff that you can go and start to study. Now I want to say this about those videos though. As you move from the beginning to the end, it's going to start out very basic, then it's going to get more advanced, but then you're going to get, as you move forward, there's going to be some things that I learned from trading every day. And I've been trading every day since February. Okay. And you're going to see me learn new stuff as the training and the videos progress.
Okay.
Okay. So if you ever have any questions, you can always call me.
I know that. I'll hit you up. You know that.
You can always, because I'm learning every day with the reflections. Okay.
Okay.
So there's a lot of mistakes I made, lost money, made money too. Now, don't get me wrong. I wouldn't be doing it every day if I'm constantly just losing money. That just doesn't make sense, but you're going to lose some money, until you perfect for yourself, your system, not what somebody else does.
Okay.
But you perfect for yourself a system, because I took a lot of classes. Let me tell you this, and I'll let you go.
Different.
Man, I spent a lot of money on training, taking classes from folks. Here's what I learned. Man, these people out here just taking your money, man.
Oh, you just
that stuff they're talking about, a lot of that stuff doesn't work. They're
Okay.
teaching people, you got to learn for yourself. But one thing I'll tell you that is a must, unless I'm a trader. There's a difference between an investor and a trader, right?
Okay.
When I say trader, that means I'm doing it every day and I'm not holding my position.
Okay.
Now, I'll let Fisher do my investment. They're holding my positions long term.
Okay.
I try to get in. Ideally, I want to day trade, which means I want to open and close my trades on the same day.
Okay.
When I have to go the second day, to me, that's speculation because I don't know what the stock's going to do on that day. Okay? As long as I'm watching it, common sense would tell you that, well, the price keeps going up. I'm going to stay in it. And when I see it get ready to turn down, I'm going to get out of it. Now, let me tell you what these suckers do, having said that. So in other words, I'm not guessing. I'm watching what it's doing.
And you're watching the market.
I'm watching it. But even with that, let me show you what these old dirty suckers will do. And they're ruthless, man. You could be in a trade watching, making money. And let me show you this. See this red candle right here?
Yeah.
That means the price fell. Look how large. Then that happened within 1 minute. It could have been 1 second. That price just boom.
How can that happen without some kind of manipulation?
That's what I'm trying to get you to see. Now, this isn't exactly a good example because here I can see my white line and my green line turning down. So I would have got out of this. So I wouldn't have got caught by that.
Yeah.
But there's some examples where everything was looking good. And then all of a sudden you get one of these large red candles. Remember, over here's the price axis. And boom, that dropped. What is that? That went from about $7 to around $6. It dropped 60 cents.
Okay.
Now, for an option contract, man, that's a whole lot of money. Look over here. If I go 60 cents out from here up to here, look at the difference in price. I went from $8 to $128.
Ugh.
Okay, the stock, I'd have to go over here to see what kind of move that was, but I can guarantee you it wasn't the greatest percentage as it was for this one. What is that? 60, let's say 60 cents divided by, what was it at? $7? That's an 8.5% drop. 8.5%. I bet you the stock didn't drop that much percentage-wise because of that leverage thing again, right?
Yeah.
So you got to watch out. You got to watch out for that. I'm going to stop it there because I sort of went over time here. Oh, one more other thing. I want to show you another something else I use. There's a lot of stuff that I didn't cover because this is just basic, but I got to show you this, and I'll let you guys go. It's called an options profit calculator. This is my secret weapon right here. A lot of people, I don't know if they know about this, but this will let you know, this will let me know I can go in here, I can do my long calls and my long puts. Those are the only two I use. And I'll go in here and I'll put Tesla. This is what will motivate you, but it also got me in trouble because I was looking at those gains and they weren't realistic. So let's say if I go in here, I can choose my expiration date. Let's say we choose August 1st, which is going to be upcoming Friday. Then I'll go down near the money, right? Up here, this is out of the money, in the money. On the call side, I can get it at the mid. Here's the bid, here's the ask, here's the mid price.
Okay.
I can get it right now, near the money. That's where it's going to be cheap, relatively cheap. I can get it for there. I'm going to pay $723. I hit calculate. And here's my secret weapon down here. Look at this here. This is going to put you above the fray if you do decide to do this. Look, is the price, here's the price. The underlying goes up. let's say if it goes from that 17, whatever it was, up to, let's say it goes this here. I'd make $266 out of that 700 and something. I'd make 36%.
That's big.
Yeah.
That's really big.
Yeah. Now that'll get me close to my $400 a day, won't it?
You're almost there.
You see where I'm okay.
Yeah.
Now I'm giving myself 8 chances to do it. Okay, because some of them aren't going to work. I'm gonna have to sell, probably get out at a loss. I manage my losses though. I'd be comfortable with this one if it just went up here. That's
a really good percentage though. 23.8%.
Yeah, that's how much I'm going to make on how much I invested, which was that $700 and something.
So you almost at your $400 goal. Well, you halfway there.
But I got to show you something else. Here's where time decay comes in. Look what happens as I approach expiration. Look what happens to the percentages.
You gotta see.
They go away.
Go away.
Right? This is why I day trade. Look, I want to ideally give myself 2 days.
Because you held on to that bad boy. Yeah.
I want to get out in that first day because if I let it go any longer than that, I'm guessing and it becomes speculate. I don't like speculating, man. I want to see with my eyeballs what the stock is doing.
Hey, man, I like your commentary on the politics too, bro.
It's study, man.
Crazy out here, man. It's crazy. It's crazy in these streets. Real talk.
I appreciate you, but that's study. It's just like this. When you see me commentating, that comes from study, man.
Yeah, I see. You bring the facts out.
Yeah.
I got our youngest daughter's in medical school, a second-year medical student, and she's the chair of the DEI program, and it's a lot of drama going on right now at Ohio State. So.
Oh, trust me. Trust me, especially in the Capitol, where in the Capitol, that's where all those conservatives are.
Matter of fact, she spoke. She actually spoke at the State House. I seen the video.
Okay.
And she wrote an op-ed. She wrote an op-ed in Columbus Dispatch.
Bad girl, huh?
She doing it, man. Maya got a bachelor's in biology, had a minor in neuroscience. Then she got her master's in public health, and then went to medical school.
Mm-hmm. Yeah, I think you introduced me to her.
You met Maya. You met Maya.
Yeah.
At that I think we was at the Alzheimer's event.
Oh, okay.
Yeah, you met Maya. She doing her lowest block score was 83, so she's doing good. She's doing good, man. Proud of her.
That's great, man. That's great. Yeah. Hey, but hey, I'm gonna let you guys go. Like I said, if you got any questions, you always you know you can call me, man. I think you got my number.
I got it. And shoot that stuff on instant message to me too.
Okay. All right.
All right, man. All right, man. Talk to you soon.
All right.